you're still talking about an incredible move up here on the price of gold that could continue. So, I mean, we could be looking at $6,000 an ounce during this bull run. And again, if you look at what's going on in the fiat currency system, you look at how the new bill in the government, it doesn't really look like it's going to cut that much spending and most likely expand the debt. Those are the ways where you start to say, okay, I could justify gold getting to $6,000 an ounce potentially because of these other factors. And I actually still think silver probably, I don't know about this year, but I think within this year or next, we at least tag that $48 to $50 level on silver.
Gold continues to trade at historically elevated levels, buoyed by the relentless demand for physical metal from central banks. Regardless of whether prices are at $1,800, $2,400, or even $3,000 an ounce, central banks remain steadfast in their accumulation strategies. This consistent buying, driven by geopolitical realignment and concerns over monetary stability, has become the most reliable foundation of the gold market, far outweighing temporary market volatility or speculative trading activity. Veteran trader Gareth Soloway notes that gold has delivered significant returns in past bull markets, gaining approximately 850% between 1976 and 1980 and 600% from 2001 to 2005-11. Applying a more conservative 400% gain to the current cycle, measured from recent lows, implies a potential long-term target near $6,000 an ounce. This projection lends weight to growing calls for a sustained reevaluation of gold, particularly as global instability and dovish policy expectations persist. In early Monday trading during the Asian session, gold attracted fresh buying interest near 3,445, marking a one-month high. As gold extends its rally, silver is also expected to follow. Soloway suggests that silver could reach the $48 to $50 range within the next year, capitalizing on its historical tendency to lag behind, but ultimately outperform gold during bull runs. While gold is setting new all-time highs, silver remains well below its previous peaks from 1980 and 2011, reinforcing the thesis that silver has more room to run. Spot silver remained relatively stable above 36 on Friday, following a brief pullback from a 13-year high. The metal continues to find support from robust industrial use, ongoing supply deficits, and its role as a store of value amid continued macro and geopolitical uncertainty. Although silver has underperformed gold for most of the past year, Soloway points out that its recent breakout marks a shift in sentiment. While gold has benefited from monetary and geopolitical catalysts, silver's industrial demand has remained somewhat stagnant. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So the beauty of this is really that what we had was this longer term uptrend from the start of the year, right? And what we can clearly see is that uptrend is still intact, right? If we connect these lows, right, low to low to low and to low, that's your longer term uptrend. So even when we were down here and we made the high at 3,500, and then in the short term we were making high, lower high, lower high, that was still holding the longer term uptrend. So the idea is you still remain with a bullish bias because the longer uptrend is still holding. And then what you can see here is amazing, right? So you had the high here, you connected to this high, price broke out, it then came back, which now becomes support, right? It was resistance here, here, and here. But once it breaks, this now becomes support. It held support and is now pushing up. So again, the idea here is that gold should continue up. You will probably see some resistance at the all-time high just because that's your natural last major high. But my guess is gold is going to continue to go higher here over the course of the year. Silver is a cool one. So this is a very interesting chart, and I went long on a breakout on silver here, but I actually did take profits just because of the extension move. But the key is I'm still a bull on silver. I just have to wait for a pullback, and we're starting to get that over the last few days. What I'm looking to do is what we see here is you basically have this zone right here, right? So very clearly, notice how this high and this high here kind of make a zone. Then you had it hit here, and then right in here. If we zoom in, notice how price went up, consolidated, and then broke out. And so as a technical trader, what I'm looking to do here now is just basically any sort of retrace into this zone now becomes major support. So again, it was resistance, pulled back, hits, consolidates, breaks out. Now it pulls back. I want to be a buyer off this 34.75 zone for a move to the upside. And I actually still think silver probably, I don't know about this year, but I think within this year or next, we at least tag that $48 to $50 level on silver. And I think
So,
that's important to understand, right? Is that silver, if you look at silver going back to 2024, basically a year ago, until this recent breakout, silver's just chopped sideways. And so it hasn't benefited from the move up in gold, which has been basically up and to the right. It recently broke out, and I attribute that not so much to industrial demand, right? I think industrial demand is stagnant, if not dropping. But I think what's going on here is that you have this divergence with the ratio between silver and gold, the silver gold ratio. And it's gotten so stretched at this point that at some point, either gold has to pull back to where closer to silver, or silver has to play catch up a little bit. And I think that's what we're seeing on silver. So the idea is that if gold goes higher, silver should benefit to some extent and also go higher. And keep in mind, I mean, even if silver goes to 48 to $50, and if we look at the chart, here you can see that all that does is gets us back to the high from 1980 and the high from 2011, right? So even though gold is making new all-time highs, silver is still lagging on a basis of new all-time highs. But I do think the catch-up trade is something to kind of monitor here, as I do think that would play. And by the way, that goes for palladium, platinum. I mean, platinum's had a remarkable run here. If we bring up the platinum chart real quick. I mean, look at this move up here on platinum. And I think same thing here is that people are like, okay, well, gold is up immensely. So a lot of people are like, yeah, it's hard to justify when gold was $2,000 an ounce at the beginning of the year. Now you're at over 3,000 to pay up. But people were like, wait a minute, if I zoom out on this platinum chart, it's still trading at multi-year lows. Same thing for palladium. So there's your catch-up trade, and then it gains momentum. And I think that's what's going on with these metals. So as long as gold keeps pushing up, you should see that catch-up trade continue. When you look at the bigger time frames, that's really where we start to say, and this is where we start to speculate. And again, just for everyone watching, it's important to understand is that you have a higher probability of predicting the future when you look a week out, a month out, maybe a few months out. When you say, okay, well, where could gold go over the next couple of years? I mean, we're all guessing a little bit more. What I use is I like to say, okay, what's my best case scenario for gold? And what I do in this situation is I look at the last bull market runs, right? So you had gold down here in 1976. It ran up about 850%. Here you had a low in 2001 over the course of essentially 10 years. It went up 600%. And then if we look here and we kind of take this low and we say, okay, well, right now, we're only up about 200%. So, I mean, if we just kind of average those two gains, 800 and 600%, even if we just did, let's even go a little bit less, let's say 400. So 8, 6, 400, you're still talking about an incredible move up here on the price of gold that could continue. So, I mean, we could be looking at $6,000 an ounce during this bull run. And again, if you look at what's going on in the fiat currency system, you look at how the new bill in the government, it doesn't really look like it's going to cut that much spending and most likely expand the debt. Those are the ways where you start to say, okay, I could justify gold getting to $6,000 an ounce potentially because of these other factors.
The escalating conflict between Israel and Iran, marked by a direct and continuous exchange of strikes, has intensified investor demand for safe haven assets, with gold being the primary beneficiary. Historically, periods of heightened geopolitical risk have triggered a surge in gold flows, and this current situation is no exception. The increased tension has reminded markets of gold's enduring role as a hedge against uncertainty. During former President Trump's tariff announcements, similar risk-off sentiment drove gold to record highs, as investors feared widespread disruption to global trade and rising economic instability. Today, as the Middle East teeters on the brink of broader conflict, those same concerns have resurfaced, pushing gold higher once again. However, analysts caution that while the recent price action is being fueled by geopolitical headlines, a significant portion of the rally may be speculative. Gareth Soloway notes that if the conflict were to expand further and draw in larger global powers, it could ignite a more sustained sell-off across equities and risk assets, creating a more powerful and prolonged gold rally. Even if oil prices remain stable, gold stands to benefit from deeper structural concerns, including ballooning sovereign debt and the continued absence of meaningful fiscal reform. Renewed geopolitical anxiety following an Israeli attack on Iran is keeping gold well supported. Iranian officials have vowed to respond firmly to any adventurism from Israel, adding another layer of tension to an already volatile region. Let's get back to the interview.
There was last night, and what's really interesting about this is what we've seen, at least on the long bond here, is that last night yields were down. We were down to about 4.32%, but we've actually moved up today on the 10-year. And so it's weird how you did see kind of that safety trade going on, but now we've seen it somewhat reverse, at least in the long bond. And again, that continues to make me very nervous about what foreign investors think about the long-term US debt, right? I mean, 3 and 6 month, 2 year maybe is fine, but what about 10 or 30 years out? And you start to see this type of thing. Like generally, you would expect the 10-year yield to be down today, and it's not. In spite of what we're seeing in the news. I think that it's just, people get caught up in the emotion of how amazing the rally has been, and it has. This V-shaped recovery has been epic, but you also have to start looking at the data and thinking very logically, not getting caught up in the hype. And if you look at it, even if deals are struck, tariffs are still likely to be at minimum 10%. That's 10% higher than they were, and that's in the best case scenario. We're also seeing an economy that's very clearly slowing. I mean, the consumer is pulling back on spending. A lot of these signals just show the stress in the system that's been building up. And remember, I mean, the government is still trying to cut a lot of programs, the funding for a lot of programs, which will also influence spending quite a bit. So there's a lot of underlying factors that really point to, at least, even if not a full recession, a slowdown where the valuations on a lot of these stocks, it's going to be tricky to justify them going up significantly. So I think, again, for me, I'm more in the more bearish camp that I think we slow down quite a bit and go into a recession. But even if you're in the base case of, hey, listen, we just kind of continue to trudge along, how much higher can valuations on stocks and risk assets go at this point? So a couple things to keep an eye on here. And we saw obviously last night when Israel struck Iran that the futures took a major dump. Oil ripped sharply higher. But really what we're seeing today is that the futures, the markets, the S&P are coming back. Now, we're still down on the day, and I expect that we will end on the day to the downside. But we can see here, if we flip over to this chart, you can see early in the day we sold off and then have just been kind of grinding back up. And I think the reason why we're grinding back up is that, while it's very jarring to see the images that we're seeing in the media, when investors look at how this will impact the U.S. economy, U.S. inflation, like the things that people are buying stocks on, does not have a huge impact at this point. Now, it's not to say that the conflict can't escalate and kind of envelop more countries, but right now it doesn't have a major impact. So the markets have been in this buy the dip mode, and I think investors are doing just that today. They're buying the dip down here. Now, I do think that the markets are getting very extended on the daily chart. So if we look at the daily chart here on the S&P 500, here's your April 7th low. We've rallied immensely off of those lows. So the markets are getting to a point where we're priced to perfection, meaning that the upside is probably limited, maybe back to the all-time highs or just above. But I think, again, until we see economic data that really gets people scared here in the U.S., investors are still willing to kind of say, hey, listen, all these other things that are happening around us, it's inconsequential as long as the U.S. economy stays strong. And just going over the recent data, the PPI, CPI numbers were okay. There was no jump in inflation. The jobs data from last Friday was okay. So all of these things are making investors say, hey, listen, we've bought the dip in the past. Markets and economy stuff are still okay. Let's do it again. I think that would definitely unnerve a little bit more. And the idea is, if it's a more regional conflict and draws in more players, what you then have is likely the U.S. getting drawn in. And that would be something that would really kind of upset or rock the apple cart, being the market. So I think it, at this point, most of the other countries have come out, Saudi Arabia, et cetera, have come out and said, hey, we don't agree with them doing this to Iran. But they've really stayed back and said, hey, listen, this is between them, between this nuclear program. If that were to change, I do think that would be a much more systemic risk for the stock market, and you would see a much more sustainable down move. I would also think gold would continue to rally higher in the near term. And weirdly enough, even if oil stalls out here because maybe things don't get worse there, I still think gold is a place where, as we see more and more unwillingness in the government to really do dramatic cuts, and the debt issues continue to mount, gold is just, it's your default go-to, and then Bitcoin kind of on the outskirts lurking.
Gold's persistent upward trajectory reflects a more profound transformation in global financial behavior, where long-term uncertainty is prompting both institutions and individuals to seek safer ground. Beyond the daily headlines and speculative trading, a broader recalibration is underway, one that places real assets at the center of capital preservation strategies. In an era shaped by global instability and eroding trust in traditional systems, will metals like gold and silver become the new pillars of financial security, or could shifts in sentiment once again tip the balance toward riskier assets? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.